Blake has a few questions for you.
Hey, Mark.
How's
Are you
that?
there, bud?
I'm
There
here.
you go. All right, Mark.
Mark, how you doing?
Good, sir. How are you?
Good. Hey, I'm gonna let Dale. I wanted to let Dale take over the interview here in a second. But as we spoke last week, and if you guys didn't catch his interview on Trader Summit, go through and you can go down to the videos and find Mark's most recent video. We were discussing the move in the yen, and as you had, well, maybe I can let you elaborate on this. The dollar yen has moved up aggressively, and so have all the other yen pairs since we spoke. I mean, I think we've moved, maybe two big figures since you and I spoke, from the 112 to the near 115 range. And you had some pretty enlightening insights regarding the yen and as far as ranges go. So do you mind talking a little bit about that, as far as because a lot of people look at the yen and they go, wow, it's really breaking down, we could really start screaming higher, but you have a little bit of a different view, don't you?
Yeah, I think that, so it's just really a subjective experience in the markets. I think that I sort of see the dollar yen pair as primarily a range trading instrument. And when it looks like it's trending, it's moving from one range to another range. And so I'm thinking first, maybe talk about the driver. I see the real driver, not something going on in Japan. They're going to have elections in about a week's time on Halloween. And I don't think that matters so much for dollar yen. For me, the key driver is U.S. interest rates. Very strong correlation. So mathematically, it seems to be a fairly robust relationship. U.S. interest rates rise and the dollar yen goes up. There might be different reasons why U.S. interest rates rise. I see a very strong correlation between higher oil prices and higher break-evens. That is, people see higher gasoline prices, higher oil prices, and they imagine there's going to be more inflation, drive up U.S. yields, and that drives up dollar yen. But if the dollar yen is this range trading pair, then what we're fishing for now is the upper end of what's going to be the new range. And when I look at the charts, I don't see it so much on what you have up here now. I'd go back a bit longer.
116.5, Mark?
Yeah, I'd go back a bit longer, but I sort of see this 115 area as important.
Okay.
And so I thought that, and we talked about this, Blake, I guess last week or 2 weeks ago.
Blake's got a trend line at 116.4.
Yeah, I was thinking that the upper end of the range, at least initially, or like the initial guess, is the 114.50 to 115 area. And so far, the market has split it. I think we got a high yesterday about 114.70. Even though we dipped below 114 this morning in Asia, it didn't move back above there. I think as long as it holds above the 113.80 area, this still looks good to keep probing that upper end of what I think is going to be that new range.
And this is a weekly chart. I was just going to say those are those levels.
And so I think to myself, why would, if I'm saying the dollar yen is 114.50, 115, and it's driven by U.S. interest rates, what is going to get U.S. interest rates to stabilize? And I'm not sure about the long term, but at least in the near term. And here's what I'm looking at next week. And this is, I think, very much like how I think you guys think about prices. You're not just thinking about what's happening today, but how it fits into the bigger picture. What's the next, like in the pipeline? What's the next thing to be anticipating? Same thing I have to do for macro. And so one of the big pieces of data next week is going to be the U.S. GDP, Q3 GDP. And what's interesting about it is that expectations have fallen. When I mean expectations have fallen, I mean they've really fallen by a lot. The Atlanta Fed, so the New York Fed has stopped doing its GDP tracker as it tries to rejig it in this pandemic environment. But the Atlanta Fed presses on, and they have cut their model of GDP tracking, making it an accounting function rather than a forecasting function. They are looking at 0.5%. That's an annualized pace of growth that the Atlanta Fed has for Q3. The market is above there. But if we come out anywhere close to that, I think that the market will conclude, so the market's already biased, I think, towards the stagflation type concept, high inflation, slow growth. And we get something like that 0.5 that the Atlanta Fed is looking at. And I think that bonds would rally, that is, yields would fall. And as yields fell, we'd see a big recovery in the yen on the crosses as well as against the dollar.
Interesting. Wow. Well, Marc, thank you so much for your insight on the yen, because I think a lot of people look at the dollar yen, they're like, oh man, here we go. We're going back to the 120s, maybe even higher. I think it's important that people hear what the drivers are for the yen currently. And to your point, rates are moving higher, and we've had a strong correlation between the dollar yen and rates. And rates are obviously probing some pretty key resistance. But as you pointed out, maybe some of the economic data, if it's showing signs of weakness, maybe it's not that time just yet for rates to move higher. I got one last question. I'm going to put myself on mute and let Dale take over. But I talked with a gentleman, Michael Brown from Caxton FX in London, in the city of London, and he does very similar work that you do at Bannockburn with a lot of corporate clients, moving money based on their businesses, whatnot. And it was interesting. He's like, he goes, I think the market's pricing in a lot of rate hikes. And he specifically was talking about the Bank of England, but we were also discussing other central banks. He goes, and he's like, I just don't think that other central banks have the ability to deliver on these expectations other than the Fed. So, and I think the comedic part of his interview was that look behind me and on my windows up here in this high rise. If you see pigs flying, we'll see that before the ECB actually raises rates. So, the point he was trying to make is that really the only central bank that can deliver on its promise of really tightening monetary policy in any way, shape, or form is the FOMC. Do you have any? And which makes him by default a dollar bull at this stage in the game. Do you have any opinions regarding that? Because I thought that was some pretty good insight from that side of the business.
Yeah, I mean, I do think that the U.S. has among the strongest inflation readings among the major industrialized economies. We've had the largest fiscal stimulus, and remember, we had a lot of stimulus even before the pandemic struck. And so it does make sense, higher inflation, strong growth, lots of stimulus, that the Fed would be aggressive. But for me, the Federal Reserve is not leading the pack. If this was a swarm of bees or the birds migrating, the Federal Reserve is not in the front of the V or the front of the herd or the front of the bee swarm. In fact, it seems to me that Norway's already hiked rates, promises to do more. I think you mentioned it before, New Zealand's hiked rates. They want to do more. And the Bank of Canada meets next week. They've been pretty aggressive. They're going to taper further, but the market's pricing in roughly 100 basis points from the Bank of Canada and the Bank of England in the next 12 months. That is well before most people expect the Fed to raise interest rates. But that's what strikes me about what's going on too. The market is getting very aggressive, and I've been talking about this for a couple of weeks, and the market's getting even more aggressive. But here's what I'd be looking at. I had begun looking at the December next year Fed funds futures. I moved back to September. But here's what I'm looking at now. I'm looking at the August contract. And the August contract's interesting because the Federal Reserve does not meet next August. So this would give us a gauge on what to expect, what the market's expecting for July. And the idea is that the Federal Reserve has indicated that it'll be done buying bonds. It'll be done sort of winding down QE around the middle of the year. So it seemed that July would be the first chance that the Federal Reserve would have to raise interest rates.
Yeah.
Assuming that they don't do it, fair value is about 8 basis points for that August contract. It's trading at 26 basis points now. 33 basis points is completely factoring in a rate hike for next July. So I sort of sitting here, and the market seems to me to be pricing in about a 60% chance of a rate hike for July next year. And remember, last month at the FOMC meeting, only half of Fed officials thought there'd be a rate hike at all next year. The market's pricing in one almost as soon as the Federal Reserve can do it when they get done tapering.
Well, Thank you, Mark, for that explanation. And I'm sorry, I'm going to step away. I'm going to let Dale go into that, or into the rest of the interview. But I wanted to say this pricing that we're seeing from, with, all these other central banks. And I think we all understand that, a lot of central banks have already started to move, but the future pricing movements have been really, really aggressive. So.
Yes, the market is very aggressive about the Fed. The market is pricing in a strong chance that the Bank of England raises rates this year still.
Yeah, I was going to say that, and I think the point was of the last conversation that I had was that they can't deliver on that, or they're not going to be able to, is what I think Michael Brown was saying, and I was wondering if you agreed with that.
Yeah, so I think that the market is getting too aggressive.
Yeah.
I do think that the Bank of Canada can raise rates middle of next year. I think the Federal Reserve, I think one hike is a safe bet. 2 hikes is pushing in the U.S. I think a rate hike as early as early November that the market's talking about for the U.K. is a bit early. I think that, again, for me, the problem is that just like inflation is supposedly transitory, growth is as well. And I think we're going to begin seeing that weaker numbers. Starting tomorrow, we're going to get the October PMIs, and we're looking at slower numbers, weaker numbers across the board. So I think that for me, the big danger, monetary policy, like fiscal policy, becomes pro-cyclical. So I agree. I think the market's leaning a bit far over its skis.
All right. Well, and we're going to be getting PMIs not only from here in the US, but we're going to be getting them all through Europe tomorrow too. So it should be an interesting read. So Dale, are you there?
Sir.
Hey, I'm going to let you take over. Mark, thank you for addressing those questions for myself and everybody listening in. I always appreciate hearing you guys. I don't want to take any more of your time with Dale. So thanks and enjoy.
Thanks
for being here, Mark.
Good luck.
Wait,
Mark.
Next
time. No,
wait, no. You always ask the right questions. I just had to ask a couple. All right. I love chatting with Mark. So I'm out of here. All right.
All right, Mark. So I'll be a little bit off the wall. What's with this guy, Mark Carney, saying that we ought to abolish the dollar?
Yeah, isn't that amazing?
What did you think when you heard that, buddy?
I was a bit taken aback for it, especially because he came to the American heartland. He says this at Jackson Hole.
Oh, that's what he did. Unbelievable.
He comes to America and says that the dollar is part of the global problem. And I'm not sure what problem it is. Of course, you have many central banks have the dollar as a primary currency and reserves. And of course, in the ideal, utopian world where beer comes out of drinking fountains, there'd be other currencies to share that burden. But the world in which we live in is not like that.
Yeah, he's a kind of a journeyman central banker. I think is he playing anywhere, or is he on waivers waiting for another job? Where do you think he'll be? What central bank will he be playing for next season?
Yeah, I think that what's interesting though to me about him is that he's moved over now, leaving aside the central banking functions, because as you know, he was like the head of the Bank of Canada and then the Bank of England. Yeah. Some people talked about him at the Federal Reserve, but I think fat chance. But I think it's interesting that people of his caliber now are recognizing the importance of climate change in a way that they didn't recognize it, say, 5 or 10 years ago. And so he's really pushing that area now, thinking about what it means for monetary policy when climate's going to be more volatile, what it means for businesses. We see this already, right? I mean, when I was getting out of grad school, we had to read so much about the Japanese innovation in just-in-time inventories. And it maybe lasted about 30 years. And through this pandemic, but other supply shocks with the climate change, more volatile weather, we're seeing the just-in-time inventories maybe is on its sort of way out. People are thinking other ways to manage inventories.
Yeah. It's interesting, Mark, what you and Blake were just talking about is happening on my screen. Maybe where yields are going to weaken into the GDP reading. If you look at this chart, we have some pretty good divergence, like a little 3 drive on it. And I was thinking before we took out 178, which were the highs in back last spring, that maybe we could pull back to 148 from here. And I wasn't aware of GDP next week and the number that's coming in. Also, the yen, same type of signal that I'm bullish looking for higher numbers, but I don't know why we couldn't have a 200 pip pullback here. Maybe back to, this was a big breakout area, maybe 1250 and then higher. So the scenario you were talking about for the GDP may be sell the rumor, buy the fact after the number, instead of the other way around. So
Yeah, I
just
think that's
want,
important, Dale. Just that whole idea of buy the rumor, sell the fact. I
yeah,
think that's something that's really unique to the markets. Most of rest of our lives, we think of cause and effect. Cause takes place before the effect, but here we're talking about people say selling treasuries in anticipation of strong data, higher
yeah,
oil prices, and
right.
and when we get something, you have to you make that adjustment. We anticipating. I think that's really the great value of the markets is the anticipatory nature of it. Not that we get it right all the time, but we're always anticipating. We really live in the future.
Yeah, I know. I'm really only 40 years old. So, also something that kind of could play into your scenario for yields to drop and the end to pull back is, last time I talked to you, you said that, every time that in your career oil prices have doubled, a recession has followed. And there is a topping formation that's developing that I've been playing this week. And if we had a break in crude, say, over the next month or so back to $70, that would also be a reason for rates to come down, and maybe even give the Fed a little cover so the market thinks maybe, like you're saying, how aggressive things are priced. That may be in November if we had a $10 pullback in crude, and we had that weak GDP number that at least temporarily, people, would give the Fed cover not to be aggressive at the November meeting.
Yeah, that seems to make sense to me. I mean, we did have that uh, the oil inventory data yesterday. It sort of surprised the market. I mean, with the softness. I don't know. I mean, gasoline is also an issue now as well, and I see
Yeah,
people paying more at the pump for it. But I wonder really, the more we have to the more cost to fill up the car with gas, the more it takes to heat our house, the less money we have for
right.
discretionary spending, and that ultimately is what drives the economy. So I'm looking at these higher oil prices and the weaker growth to be pointing in the same direction.
Okay. And, I wouldn't be surprised, knowing the administration, it wouldn't be the first that he's hearing that the current administration's hearing a lot about high prices, and people go to the pump every day, so it reminds them every day they go to the pump probably more than they go to the grocery store. And so I wouldn't be surprised to see the administration um, do something with the strategic petroleum reserve and release some. It may not be smart, but politically it would take some heat off them. What do you think?
Well, I think that yes, I fully agree. This is what how could the U.S. call OPEC and say, please produce more oil when we have strategic reserves and I
Yeah,
refuse to tap them? But having said that, it
yeah,
seems to me that the interesting thing about us tapping them, I mean, China is also actively intervening in its commodities market,
yeah,
and people are shocked that they would try to do that to try to influence prices. But the U.S. is going to tap into our strategic oil reserves, but not to drive, not the purpose, not so much to drive the oil down, but the purpose is to meet some budgetary compromise deal. That liquidation of some oil helps meet some budget issues, and it's
right.
just it's unfortunate. But I think that that to me the issue here, and as you hint at, the rising price of oil, the rising price of gas, And remember, the food that we eat is heavily influenced by energy prices. The fertilizer, the pesticide, all carbon-based, natural gas, oil, and so as people pay more for food and energy, what I see happening is the President Biden support is waning, and that's what really concerns me on sort of the 12-month outlook, that the Democrats may lose both houses of Congress. And that then brings into question about fiscal stimulus, globalization, internationalization. It just makes Biden appear to be possibly a lame duck this time next year.
Yeah, well, look at this. No wonder you and I are masochists and got into this business. We've been lifelong Cub fans. Oh, anyway, we know how to suffer. Anyway, you know, I thought I was in the Twilight Zone when they finally got into the World Series after 100 years. So, Mark, it's always enlightening. I just want to cover one more topic, and it would be, we're almost at a level you thought Canada could get to. Last time I talked to you, you're talking about maybe 122 by the end of the year. So, you know, we're starting to put in some type of little, you know, wedge type of formation. I know you're very bullish on the Canadian economy. Could there be an upside correction coming? Maybe if I'm right. I know you also, everyone listening, even though I do and many other analysts do talk about Canada and WTI together and the correlation, Mark says it's not a petrocurrency. So what kind of currency is the loonie if it's not a petrocurrency? Natural resource? Go ahead.
No, so here's how I started to think about it. When I look at the flows of energy in and out of Canada, because remember, Canada imports expensive Brent oil in the east and exports the cheaper stuff to the US in the west. And when I look at that and I compare it to the daily volume of dollar Canada, the capital flows still are much bigger than the oil flows. And so how do I think of the Canadian dollar? Well, if you tell me the direction of the stock market, the S&Ps, that right away gives me a directional bias, because I sort of see the Canadian dollar most of the time trading like a risk currency. That is, if you're indifferent to either the Canadian or US dollar, for example, your margin money could be kept in US T-bills or Canadian T-bills. What should you hold it in? But when I see the stock market rising, that tells me people have an appetite for risk and will prefer Canadian dollars. Doesn't work all the time, but it gives me that directional bias. What I'm looking at is the head and shoulders. I think you have that sort of in the beginning of this chart. Head and shoulders breaking down, and the 123 was the target. Was my target. We got down to 122.90 or so last night. Maybe it's 88. And I think that's it, in the sense that I think now we should be looking for that upside correction. That this was sort of the last marginal new low that's not sustained. It reverses off of that. Whether we get that reversal pattern, a hammer candlestick, or a stronger reversal pattern, I'm looking at that 123.50. We get above there, and I think we get another leg up, 124, 124.20, and then we can come back off. The Bank of Canada does meet next week. I expect them to taper. So right now they're buying about 2 billion Canadian worth of bonds a week. I expect them to cut that in half and keep the market, encouraging the market to really look for a rate hike in the middle of next year rather than a bit earlier like it currently is doing.
Okay, Mark, thank you so much. I know, Mark, your reputation precedes you, especially into here. You know, Blake and I rely on your outlooks and your insights on fundamentals, and I know thousands of traders do. So if you're not familiar with Mark, go to his website, marktomarket.com, right?
Marktomarket.com. And you can find me on Twitter too. I try to keep active there as well. There, it's my Twitter handle is Mark Making Sense. Comes from the first book I wrote called Making Sense of the Dollar.
Okay. And right here, Mark, where it says work with us, what are you looking for on this forum? People that businesses that may need some foreign exchange help, or are you looking for employees? What are you looking for here?
Well, we're looking for always looking for good talent, but we also work very closely with small, medium corporations as well as funds, and so what we're trying to do is, the thing that strikes me is that the large institutional players, hedge funds, large corporates, large asset managers. When you look at the euro, you see four digits on the other side of the decimal point. Well, in practice, those big pools of capital, they're paying, and there's another decimal point that you, as retail, or I, tend not to see. We try to make that more available. People,
Okay.
when we look at how small businesses, and this would probably include a lot of the retail, what are they really paying above spot?
Yeah,
Sometimes
they're
I
getting ripped
see
off, aren't they?
3 and 4%. So
That's
just like,
ridiculous.
when we buy something, we know we go to the store, we buy a suit, we buy a shirt, we know
Yeah.
that we're paying a retail price. That same concept works with money. There's a retail price for money and a wholesale price for money. And what I'm trying to do, what Bannockburn's trying to do, is bring that wholesale price of money to people companies, funds that are often treated like tourists.
Yeah. Okay. Well, great idea, great goal, especially in times where, people have to watch every buck they spend, and profit margins being squeezed by materials and not being able to get parts, etc. It's a great mission, Marc, and it's always great talking to you. You're one of my favorite people to talk to and do interviews with, because I could ask you anything. I appreciate that about you, buddy.
Thank you, and good luck to everybody. Besides being smart, we need some luck.
Yeah, we're all for luck. Okay. I had some luck this week, and I'm grateful for when it happens, because I've had the other two. So
Yeah,
Marc,
sometimes if it wasn't for bad luck, I wouldn't have any luck.
I knew I knew you were going there. And let me leave it with this, Marc, and I want you to think about this. What good is happiness? It can't buy you money. All right, buddy. Marc, thank you so much for your time and your insights. People are saying that was a great interview. They're thanking you, and have a great fall trading season. I'll be in touch with you to book another day early next year. Okay, buddy?
Great. Thanks. Good luck. Bye-bye.
All right. So good luck from Marc. Good luck from me. Remember, don't just count your pips, count your blessings. We'll see everyone tomorrow to wrap up the week. You could join the crew on the Morning Edge in 15 minutes. Oh, and you can't join the crew if you haven't subscribed, at least to Light. So if you want to know what's going on in there, you have to join. That's all. Invest in yourself. We'll see everyone tomorrow. Adios.